Hello everyone and welcome to the Westpac post-RBA discussion. I'm joined today by Bill Evans, our Chief Economist, Damien McCullough, Head of Rate Strategy, and I'm Martin Wetton, Head of Financial Market Strategy. Bill, today the RBA left rates on hold, as was largely expected by everyone in the market. It's Phil Lowe's last meeting, inflation's coming down, growth is still reasonably good, although we are seeing some slowing down in the consumption side. How do you think he's leaving his legacy now for the incoming Governor, Michelle Bullock?
Look, Martin, I think he'll be pretty comfortable with the progress he's made on inflation. That was always the big objective. But having said that, the economy is quite weak at the moment. The consumer is under enormous pressure. We haven't seen the sort of drags on consumer income from taxes, from rising interest rates, from high cost of living since the early 1990s. So we think that growth this year will only be about 1%. And next year 1.5%. So there's been quite a substantial cost in bringing down the inflation, but I feel that he probably feels pretty comfortable that he's done a fairly good job in pushing the economy in that direction, and he's avoided a recession. You know, you say avoided a recession, but if you got growth at 1% and population growth at 1.8%, that's a per capita recession.
Yeah, that's right. And Damien, the market reaction was, I guess, fairly muted by and large. The rates pricing was pretty much square for coming into it. We've got a little bit of a hike into the end of the year, not much, and then a fairly steady path out to next year. How do you see that progressing? And I guess if we also talk about how the Australia-US bond spread has traded recently, where it's gone more negative, any thoughts on that?
Yeah, I think that for some time now the market has had a chance of a further rate hike factored into the forward cash profile. That's been pared back a little bit prior to this meeting, and it's probably going to stay at this kind of lower level, but the market's going to have a little bit still priced in. I don't think that would be surprising to anybody, just given the fact that the RBA is still weighing up whether or not they go or whether or not they're on hold. Bill makes the point that, you know, with every successive meeting that the on hold will get more and more sway. So I think that the concept of the RBA on hold for an extended period of time, it's well known. The market will be playing around with the beginning of easing cycles, but it's too early to be talking about that now. So I think that an extended period of on hold is what most market participants should be trying to calibrate their investment decisions around.
Yeah. Bill, you recently wrote that the outlook for the budget was actually quite bright based on the commodity prices into next year. Can you maybe discuss a little bit of that?
Yeah, Martin, so the government's prediction on the iron ore price, and we'll just use that one, but it's common across coal prices and lithium prices, etc. Very, very cautious. So they're expecting the iron ore price to be $60 in March next year. That was the budget forecast. It's $116 at the moment, even though the Chinese economy is having difficulties in the property sector. There's other parts of the economy that are using the iron ore, infrastructure in particular. And the iron ore companies have proven to be very adept at controlling supply and trying to hold the price up accordingly. If you've got a product where you've got your cost down to $30 a tonne and you've got prices over 100, you work pretty hard to keep it there. So over the 3 years, the deficit for 22-23, the deficit for 23-24 and 24-25, we think there's about a $60 billion improvement, and we're expecting a surplus in 23-24 based on our commodity forecasts. So I think at the end of the year, when we see the mid-year economic and fiscal outlook from the government, they should be revising their view. They probably will be cautious, but it's going to be pretty hard if you're talking in December and the iron ore price is at $116 and you're talking 60, it'll be pretty hard to justify that. So there's possibility that they'll revise their numbers, and that may indeed provide them some scope for some fiscal stimulus at the end of the year.
Actually, I didn't answer the second part of your question.
I was about to lead on to that,
which is very linked to what Bill was talking about, because the market is now really getting this sense that potentially, that maybe they'll provide some fiscal stimulus, but potentially the borrowing requirement that the AOFM will have to get pared back significantly. I mean, that's already feeding into market pricing as we speak, and Aussie, where Australia sits in a relative basis to US interest rates is that's certainly at the long end, the 10-year. We're below them, and they're both heading in different directions. The Fed's got higher.
It's a remarkable situation where, while economies are slowing, Australia's once again blessed by what we have in our ground, and that does mean a lower borrowing program is more than likely. That's in sharp contrast to what we've seen for most other sovereigns around the world, particularly the US, which has helped, as you say, bring that spread in.
You think it will sustain that sort of level and perhaps go even further inverse?
Exactly. One thing that didn't come up perhaps in today's statement from the RBA was the fall in the Aussie dollar recently, Bill. And I guess what I'd like to ask you is how much of a further fall, or what we've seen so far, could potentially feed into tradable inflation prices, or inflation being a little bit higher on the tradable side, and the RBA keeping that narrative that if we need to, we can hike rates further?
Oh, look, I think we've seen this in previous cycles. Jawboning to try and support the currency works for a while, and then people start to lose confidence, and you've got to act. So most of the evidence we've seen is that the Aussie dollar isn't that important for the big inflation story. It's more about wages and internal pressures like that. So they won't want to see a very weak Aussie dollar, but if they felt that raising rates was going to be damaging for the economy, I think that they wouldn't raise rates to protect the Aussie dollar. And a lot of it also depends upon the Fed, what the Fed is doing. The market, we're still comfortable that they'll start easing in March. We think that the progress the US is making on inflation is better than expected. So by the end of the year, 6-month annualised, we've got US inflation back to 2.5. I think that'll be enough, because Powell has said that he doesn't want to get back to 2% before he starts to cut rates. So the Fed will be cutting rates before the RBA next year, and that will certainly provide some support for the Aussie dollar.
In light of sort of the RBA being at this peak period, one thing I guess that's been coming in and out of people's opinions is quantitative tightening for Australia. May I ask you both what your views on the likelihood of this is, and I guess, is it a policy with much efficacy at this point? And I might ask you first, Bill.
Look, where bond rates are at the moment, I think you'd probably sell quite a few of the bonds to the private sector, to the public. I'm not sure whether it would create much of a distortion, to be honest. And I'm not sure whether they see that as a really important policy option, particularly given that they're marking their portfolio to market. So it's not that we've got these toxic bonds and we have to get them off our books. We've actually come out and accepted the fact that whatever it was, 50 billion, 60, Damien did the numbers for me when we were writing about that before it actually happened. And it's a big number. So I'm not sure whether that would be a real urgent policy for them.
Yeah, that's interesting, because I think the model of quantitative tightening that the market's playing with right now is actually selling back to the AOFM, and the expectation that we were talking about lower borrowing programs, that would increase the borrowing programs, and given the size of the bond purchases, if you wanted to say run down the balance sheet by 5 years' time rather than the 10 or 10 plus that it currently is, that would be about another 20 billion a year on top of your funding of your budget. So that would be an offsetting piece. But if we could go to the private sector, I think that's an interesting call. At the moment, I don't put. I don't know what percentage to put on it, but my opinion is that it's. I don't think it's imminent. Would be my opinion.
All right, so the RBA stayed on hold this month as expected, and next month we get the new governor, Michelle Bullock, who will be running it from here. Thanks everyone for listening, and we look forward to speaking to you next month.